The inherent risk of banks, a historical perspective. Did you know that banks are always at risk of failure? The next few minutes will explore the inherent risks associated with banks and how they operate. We will delve into the history of money, the rise of fractional reserve banking, and the role of central banks. Additionally, we will discuss the current commercial real estate crisis and provide some tips on how to keep your savings safe. So, let's get started. The evolution of money. To understand why banks are always at risk of failure, we need to go back to the beginning of how gold became money. Thousands of years ago, gold emerged as the dominant form of money due to its scarcity and ability to maintain its purchasing power. However, as the wealth of goods and services grew faster than the money supply, gold transitioned from being used as a medium of exchange to a store of value. The birth of banks. As gold became a store of value, people needed a secure place to store their wealth. This led to the invention of banks, where individuals could deposit their gold and receive a piece of paper in return. These papers were redeemable for gold, but over time, people started using them as a medium of exchange instead. Banks realized they could take advantage of this situation and began lending out the gold they had promised to keep secure, giving birth to fractional reserve banking. Fractional reserve banking. Fractional reserve banking is a practice where banks lend out more money than they actually have on deposit. This creates a maturity mismatch, as banks have on-demand liabilities but long-term assets. In the event of a bank run, where depositors rush to withdraw their money, banks may not have enough assets to pay back their liabilities, leading to bank failures. The rise of central banking. Around 300 to 400 years ago, governments nationalized fractional reserve banking and established central banks. Central banks allowed banks to continue practicing fractional reserve banking under their supervision. However, the rise of central banking has also led to numerous crises throughout history, such as the Mississippi Bubble, the Great Depression, and the 2008 financial crisis. The end of the gold standard. In 1971, President Nixon ended the gold standard, which allowed the Federal Reserve to operate as the bank for the entire world. However, the world realized that the Federal Reserve did not have enough gold to redeem all the dollars in circulation, leading to a run on the bank. Since then, the world has operated on a paper money-only standard, but the risks associated with fractional reserve banking remain. The commercial real estate crisis. Currently, a commercial real estate crisis is looming, with approximately $1 trillion worth of commercial real estate loans maturing. Many commercial real estate owners are unable to pay off their loans due to higher interest rates and insufficient cash flow. This crisis primarily affects small regional banks rather than large banks like Bank of America or Wells Fargo. Tips to keep your savings safe. 1. Diversify your savings by investing in gold and Bitcoin, which can act as a hedge against inflation. 2. Avoid keeping more than $250,000 in any single bank to ensure your deposits are fully insured. 3. Look for high-yield savings accounts or money market funds that offer better interest rates than traditional banks. 4. Consider investing in short-term treasury bills, which provide a relatively risk-free return. Conclusion. Banks are inherently at risk of failure due to the practice of fractional reserve banking. Throughout history, this practice has led to numerous crises and bank failures. The current commercial real estate crisis further highlights the risks associated with banks. By diversifying your savings and following some safety measures, you can protect your wealth and navigate these risks effectively.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.